Hello Trade Pros, Victoria from Trade Pro Academy, and today we've got a special video for you. We are going to be doing a beginner guide to a breakout strategy. So the ultimate beginner guide to a breakout strategy. I'm going to present to you a very simple strategy that you can apply to any market. I'm going to be focusing on the futures market as that is what I do day trade. And from there, we are going to break it down for you step by step, give you three simple steps, just three simple steps to identify this breakout trading strategy and use it in your tool bag and in your arsenal. I want you guys to smash that like button and hit that subscribe button to notify you when we do go live every day, every morning, and catch our latest videos on the weekend. So with that being said, we've got a link down below linking to order flow trading, a free order flow trading course just for you. So let's go ahead and get started with this ultimate beginner breakout trading strategy. First, we have to identify what the breakout trade is. So there's three main trades that we look at when we do trade in the futures market every single day. So they go as follows. The first one that we all learn is a momentum continuation, trend continuation trading strategy, which is a pullback. All we do is try and buy the dips in a bullish market or sell the rips in a bearish market. It's a pullback. Every time it pulls back to a key support resistance level, we try and catch the trade in the direction of the momentum. Now, we've talked many times about the pullback strategy. It's a very simple and very easy to learn strategy, and I think a lot easier to actually gain consistency and profit than the other two. Now, the second one is the fade strategy. So when you see a market trending up or down, the fade strategy is trying to identify where the trend will end and actually catching the reversal of that trend to fade it back down or fade it back up. So in a bullish market, in a bullish trend, what you're doing when you're fading is actually selling, trying to sell a top to get it back down into the next support zone. In a bearish market, what you're doing with the fade, again, the opposite end is you're buying the low of the market in anticipation that we do press back up and you catch the long for that reversal. Now, there are methods to this madness in the fade, but that's not what we're going to be talking about today. We're going to be talking about the third and final one, the breakout strategy. What this is a directional trade. So you are identifying the direction of the move, whether it's up or down, and you're looking for key resistance or key support levels where the trend will break out and continue. Right? So if it's a resistance that's been failed multiple times, you're not looking to buy this top or just buy right in front of it in anticipation that we do break out, but what you're doing is trying to identify when and where it will break to continue this trend, whether it's up or down. So that's what we're going to be talking about today. To the downside, you're trying to identify where the market may have bottomed out and where it has strength to actually break that bottom. Same thing to the upside. So we have to identify first how the breakout is formed. So how is the market structure? How does the market form a breakout trade? What you have to first understand is that it's very market structure based and very zone based. So if you're drawing support resistance zone, support resistance levels, this is a key understanding on a larger scale to identify where the price will break out. So a level that's failed multiple times, you can see you do have the potential or anticipation that will break above that area or down below. How are these levels formed? How are these resistance and supports formed? What you're looking for in a breakout is identifying where price is rejected aggressively. What we're doing is identifying V tops like this and V bottoms like this, where price has been rejected at the top or at the bottom aggressively. What that means is, for example, this V top right here that we've outlined, let me just make it a little more clear. This V top that we've outlined right here, what that does is it presents the sellers with strong selling opportunity at this top. So when price pushes up into this level, instead of just continuing up, the sellers come in, reject the resistance point and press it down. So that means there's strong market selling right at that level to actually push it a lot lower. So what we've done at this point is we've created buy stops above. So what do short sellers have? If short sellers are going to protect themselves, they've got buy stops to the upside. So what we're doing in this breakout trade strategy is we're hunting stops. Now it's the same thing to the bottom. A V bottom is rejected at a key support level by strong market buying. That's what pushes the price actually back to the upside, the strong market buying at a key support level. So again, the same thing accumulates underneath these V bottoms, and that is sell stops. Sell stops galore accumulate, and what you can expect is when sell stops and buy stops are hit, they're moderately close together, and what happens is price actually flushes through them, giving us the opportunity for this breakout trade. So how can you spot the breakout trade based on market structure? We've helped you identify it, and that is mainly by looking at V tops and V bottoms, key areas of rejection, support resistance lines. If you draw your support resistance levels that have been rejected aggressively, you will find opportunities to the other side for breakout trades. For example, current market structure right here, you've got a key resistance around these 60s, 65s. Above that level, what you're going to see is a buy stop run to the upside. And then to the downside right here, we've also got a very key support level where price has been rejected. And ever since, we have not tested that level. But before we get to this key support level, you've got another support level, another support level, and another support level where rejections have happened. And under each of these support levels, you will find sell stops. And the ultimate sell stop is right here where this aggressive V bottom had formed through that level, through these 90s, through these 85s. We will see a aggressive push to the downside, wiping out all the stops. So this is the 3-step process that we have to follow. Number 1, identify those key support resistance zones that I have identified here, key rejection points where you'll find the stops. We're stop hunting in this trade strategy. Number 2, we're gonna have to learn how to place the limit either above or below these rejection points for these stops so we can actually capture some of this breakout trade. Number 3, what we're doing is risk managing, identifying where the potential target may be and how to actually scratch out of the trade if it doesn't go your way. So number 2 helps mitigate number 3. Number 2, by knowing where to actually enter the trade, can help you really alleviate a lot of the risk and a lot of the thinking that goes behind step number 3, actually managing that trade. So to quickly understand, what we're doing is stop hunting. For those who don't know what that is, stop hunting is the act of identifying where we can anticipate other market participants' stops may be. So these happen at key rejection points, because to get long or to get short, ideally, it doesn't always have to be the case, but to the other end, you have stop losses. And what we're doing is looking for where the stop losses are and hunting them down. So if you see a market just get rejected and pop up like this from a V bottom as it did here, what do you think these guys are doing? What they're doing is actually buying aggressively at market, trying to prop it up. And when they do have it at market and where they're in and it's popped up, they move their stops gradually, right? But for the most part, a lot of them have stops that are under this key rejection point. These are sell stops below, right? They're stops for longs that require them to sell to get out of their position. Now, to the opposite end, where the resistance lies, what happens there is that there's strong market selling. Market participants start selling aggressively. And for them to get out of their short, they have to have buy stops. So they have to buy their position back. So it means buy stops have accumulated above these certain levels. The key to this trading strategy that I'm going to show you guys is looking at a wider tick chart or a wider scale chart. So right here in front of me, I've got a 20 tick chart. Looking at a 20 tick or a 1 hour or a 4 hour or a 30-minute, whatever your trading is, if you're day trading, swing trading, this is how you identify a larger scale where there's these key rejection points where you want to see the market reject the price aggressively, right? So if I zoom out of this 20 tick, what we can see is very, very clear rejection points if I highlight them for you guys. So there's one over here. There's one up here that comes into consolidation with this area, right? There's one over here. And you can find more intricate ones like here, maybe even here. But this buy stop run already happened. You can see it actually occurred. So we had this key rejection point right here where the sellers came in and aggressively pushed price lower. Buyers did the same on the opposite end. And what happens above this key rejection box, you get a buy stop run that's worth about 20, 30 points, which is amazing. This is the S&P 500, by the way. So we want to identify these key levels and key zones if we're looking for this breakout trade. That's step number 1. You identify your support resistances based on rejections. Step number 2 is how do you enter this trade? So entering this trade is a bit interesting because what we're doing is not trying to anticipate that the price is going to break out and buying it here after it hasn't even tested this resistance point. But what instead, we're actually trying to capture some of that buy stop move and get on the other end. So we are becoming a part of the buy stop. So when you enter this trade to the upside, if you have a level right here and price has been rejected here before, as we've seen in this example, as price is coming up, the worst thing you can do is start buying here because you decrease the probability that you're actually going to get that break through this rejection point, right? What you're doing when you're buying here is anticipating or hoping that you get that break above. But what could happen is it fails at this level and then stops stops you out, right? It could fail at this resistance. That's why it's a key resistance. So instead, what we do is actually wait for this key area to actually confirm that it's going to break this resistance point, and we're trying to layer in some buy stops. So we're trying to get in. Maybe some people might get in at market once we get this break, where the buy stops, once you get through that area, triggers your entry for the continued push to the upside. So again, to the downside, it's a very similar situation. So if we identify, let's say, this level, because leading up to this right here, to the right of this line, if you're looking at this level right here, this is a key rejection point. So that means you've got sell stops underneath. As soon as price gets into them, instead, if this is your support zone, instead of selling it right here and in anticipation that it drops down, let's wait for it to break that support level as it did here, and then you let your sell stops run, or you get in at market towards the break of that area for the flush to the downside. So that's step number 2, how to actually place these entries. Step number 3, how to manage the trade. So a buy stop and a sell stop run, they happen very quickly. The point of a breakout is to happen fast or don't happen at all. That means we have to be very, very quick and diligent on our flatten buttons, on our escape buttons, to get us the hell out of those trades if they don't go immediately. So the second you get into this trade, you want to see profit right away, some kind of profit, whether it's 10%, 20% of your expected profits, right? Otherwise, you have to get out of that trade, and what you might be experiencing is actually a head fake and then see a rebound back into that area. Now, when you're trading this strategy, you have to have a target, right? So if we're selling down here below this sell stop idea, the target should be somewhere into the next support resistance area, which actually comes into consolidation with the bottom of where the price actually stalled. So keep that in mind. You have to understand where the next support resistance area may be if you're using this strategy. Now, a little bonus for you. If you guys understand what order flow is and inventory, you're going to have a much easier time actually trading this strategy. What you can do with inventory, remember, big offers to the upside attract price, big bids to the downside attract bids. If you have a key rejection point, a key resistance, and you see some offers layered in just above it, what I like to do personally is put my buy stop above those offers, because offers, for the most part, don't really clear aggressively on the S&P 500 on the first touch. So what I want to do is mitigate my risk by letting them clear and actually getting me in after they clear for the next move to the next offer level. So the best thing that could happen is you following these offers, and if more offers continue to move up while you're in this position, that means that there's more potential to the upside. What I like to call is staggering my levels and my inventory, so hiding behind both levels in inventory. If a key support level has big bids underneath like this is great, because all we can do is just set our sell stops just after those bids, hide behind those bids, and what we do is ensure that the bids get filled to actually press price lower through that area. If you're anticipating just getting filled where those bids are, just a few ticks below this low, what that does is potentially gets you in the trade, head fakes you just to get stopped out. So that was a little bonus for you guys. But if you want to learn more about this breakout strategy, we do it on a daily basis in our room. This was just the ultimate beginner's guide. You need just these 3 steps. Number 1, identify those key rejection points, support resistance. Number 2, know how you're getting in based on buy stops, market orders, and how you're getting in based on that rejection. So if you're going to wait for the rejection to get broken, you increase your probability of actually getting a good breakout trade. Number 3, manage that trade. So know when you're getting out, know where your target is, and how you have to get out if it doesn't go right away, because this is a fast breakout trade. When stops get hit, they get hit fast and hard, as we've seen to the downside in the most recent crash. So with that being said, guys, try this trading strategy out. This is Victoria from TRADEPRO Academy. Let me know if you enjoyed this thing. If you want to see more strategy videos, just drop a link down below. If you want to see this in action, come join us in the live trading room. And we have an elite room after every single morning where I walk through some trades, walk through some ideas with our TRADEPRO family. So I hope you guys enjoyed this video, and we'll see you guys next time.